Tim, if I was in Europe now and I wanted to put my money on short term, say 1 or 2 years, in either bonds or a bank, how much would I get for it?
Well, after the 5th of September, you'd be really quite spectacularly disappointed. Short-term interest rates, that's the overnight, minus 0.2. That is, people would have to pay to keep their money in the bank. If you decided to extend a little longer and buy a government bond, a 2-year government bond, here in Australia you'd get a positive yield, maybe not what you're used to, but in Europe, in 10 countries, you'd have to pay to have the government manage your money, probably about 9 basis points, that's 0.09%. That's just extraordinary. Pay a government to manage your money?
Have we ever seen this before?
Not that as I can recall.
Why is this taking place in Europe?
Europe's growth has been pretty slow. Their inflation has been coming down fast. The central bank has tried to act by cutting rates into negative territory, and government bonds have followed.
You could see some huge losses if the rates ever went up.
You could indeed. This is painting the bond market into a really nasty corner. It's simply not reasonable for your first day in bonds to go and buy this paper unless you believe there's a greater fool who wants to pay an even greater price to lend money to a government. And I don't think there's many of those.
Let's swing ourselves across to America. And we've seen some incredible volatility in the US bond market. What's causing that?
Well, the US is probably the one country in the world, the big country, that's been growing most strongly. The problem is that it's been slightly less impressive than the most of the optimists would like. What that's caused is interest rate expectations, or hikes, that's going up in interest rates, to be pushed out in terms of time. But allied to that is the fact that 87% of all US fund managers in fixed income are underweight their own bond market.
Really?
So what that really means is when the bond prices start to go up because the yields are going to stay lower for longer, that really hurts them and they start to panic, and guess what happens?
Well, just this week we've seen on one day the US 10-year bond rate gyrate dramatically.
Yep.
What was somebody short or long? What caused that?
Well, we gather that there has been various fund managers who have been short volatility. That is, like they're behaving like insurers, underwriters. They want nothing to happen. In addition, we have people who are underweight. You can imagine, therefore, that the worst thing that can happen is a rally in the price, causing those who are short to cover, causing a market move which caused the underwriter to have to act as well to protect his position, and so it snowballs. To put it into real numbers, we've seen interest rates fall from about 2.3 to yesterday 1.86%.
This is 10-year bond interest rates.
Bond is. Every reasonable bank and analyst was talking about the end of 2014 seeing interest rates back at 3%, and here we are below 2. It's a massive surprise, very painful for many people, but that's what's happened.
Our Assistant Reserve Bank Governor, Guy Bell, has warned Australia, and indeed the world, that at some point of time we're going to have a catastrophic situation in the debt market. Do you think he's right?
Catastrophic is when there are defaults, and there doesn't seem at the moment the need for an awful lot of corporate bond defaults, nor actually with improving government finances, a lot of government defaults. However, there is very little margin of safety left in almost any bond price. What I mean by that is the income is so low that you don't take much of a shock or potential shock to cause your total return to be negative. So we expect total return bond funds to print negatively over the next 2 years. Not catastrophically bad, 5 or 10% down, but that is so unusual after 30 years of bond rallies that this part of your portfolio, a small part, a quiet part, might actually produce negative returns. It's such a strange concept.
What Guy Bell is warning us about is that when global and particularly American interest rates rise, there'll be big falls in bond prices. And as we saw this week, that can create enormous volatility, which could damage individual institutional investors.
It could do. I say enormous damage, 5 or 10% drop. in a bond fund that has those sort of instruments in them is quite possible. I don't think we're going to get to the point where we have an 80% loss. For that, we'd need to see defaults. And we're seeing, for instance, in America, the government running a smaller deficit. It's got better tax revenues. Most governments are doing better than they were in the immediate post-GFC era. So, and corporates are generally in good shape. You know, they've got quite a lot of cash. They borrow long-term, not short-term. Life is pretty good. However, the risk is that the bonds just might temporarily reprice. That's why a 5 to 10% fall is quite possible.
How do we get out of all this? Is there an end game?
Well, I think if you speak to someone like, or listen to the IMF, Christine Lagarde is talking about the new mediocre. So I don't think we're going back to 1979 level of interest rates. We're going to go to some low levels, 2, 3, 4 across the English-speaking world. That's going to be the sort of new normal for short-term interest rates. And therefore, every saver's expectations have to come down to reflect that 2s, 3s, and 4s are going to be the new normal. Now, the good news is for equity investors is that dividend yields often exceed bond yields, and that's probably going to keep people quite excited by equities. How do you rapidly shrink a debt stock? Well, that's how you do. You have defaults or you have inflation. With oil prices down, food prices down, and wage growth being pretty limited, I think about 2% across most of the developed world, we don't see inflation as an immediate threat to bond investment. And default is still quite remote. So I think it's more a temporary price drop as we move from incredibly low or negative bond yields in certain cases back to something like the new moderate or new mediocre. The end game, however, is still reasonably positive.
Thanks, Tim.
Thank you.